Well, there may now be a new record low cash rate in Australia, but in the United States, the interest rate cycle is supposed to be turning, and there could be some early warning signals for those heavily invested in shares. Fund manager Roger Montgomery joins me now. And Roger, let's talk about bond rates, because you think you've spied a canary in the coal mine here, I think.
That's exactly right. It's reminiscent of 1994. Interest rates on long bonds in the United States, 30-year treasuries, have started to creep up over the last week or so. And what we're seeing is even larger rises elsewhere in the world. So in the last 4 days, the Australian 10-year bond rate has risen from 2.23% to 2.85%. And that doesn't seem like a big deal. It still seems like very low rates,
yes,
but it's definitely going in the wrong direction. Now, in 1994, when this happened, the US Treasury, US Federal Reserve raised rates just once, and over the ensuing 10 months, the long bond rate went up by about 205, 206 basis points. But then in countries
so that's
where...
just over 2%.
That's just over 2%.
Yeah.
And then elsewhere in the world where you would expect interest rates to be higher than the United States, not only did those countries, Spain, Italy and so forth, not only did their rates go up, but the spread widened. So we've had a we've had what's called a premier compression. So the difference in those rates has compressed massively. It's the lowest difference between Spain and Italy,
yes,
Italy and Germany, Germany and the United States that we've ever seen.
But this matters is if that sort of thing is repeated, then presumably the returns you can get on bond investments as compared to equity investments start
Correct.
becoming really interesting.
Well, there's not only that migration, that transfer mechanism that exists between cash on deposit or in bonds and the equity market, but the way we value assets changes as well, because we use the 10-year bond rate as our base rate for our discount rates for valuing companies and for valuing all assets. And interest rates act like gravity on Earth. If interest rates go up or get stronger, then they pull asset prices down.
And do you think there could be a change of rates in America this year?
Well, anything's possible.
Yeah.
I don't think the economic growth rate is justifying it just yet.
No.
But that doesn't matter. At the long end, the market will determine rates, and that will affect how we value stocks, and that'll affect the stock market.
All right, well, let's move to banks now, because Westpac's poor profit results on Monday. We then had ANZ, which was a little bit flat. There's a lot of talk about analysts downgrading, and I see even one bank is talking about the possibility of the entire banking sector here being re-rated.
Well, I'm not surprised. They're over-earning at the moment, so this is as good as it's going to get. You have to remember that we don't require interest rates to go up in order for people to start borrowing less. All that needs to happen is that they've bought enough. So the economics of enough starts to take over, and if everyone who was going to borrow to buy a house has done so, and I saw Joe Hockey's pleadings today to go out and borrow more at precisely possibly the wrong point in the cycle.
Yes.
Again, don't ask a barber whether you need a haircut. I'm very concerned that the banks are over-earning. Now, ANZ's result was very good. They had strong growth in Asia-Pacific. They had strong growth in New Zealand.
But even Mike Smith was warning there about very significant margin compression in the future. And then they've also got APRA to deal with, this possibly this reweighting of their
well, we talked about that early. We talked about that late last year, and the mortgage risk weighting ratio is going to change. The amount of capital that the banks are required is going to change, and that's going to make the playing field between the majors and the regional banks more level. And so I wouldn't want to be overly invested, and I know a lot of retirees are, but I wouldn't want to be overly invested in the banks.
Yes, and don't go out and borrow and invest in banks?
No, I'll disagree with Joe Hockey there. I'm happy to see the outcome of that in a year or two's time.
Roger Montgomery, thank you for joining us.
It's a pleasure.